Michael, good morning. Thank you for being here. Now, I was a little bit concerned when I saw the number one cause of death for Forex traders. I was hoping that people don't literally die at the market. Now, just throw more light on that. Why does this happen?
It's not like they die. We're actually looking at the death of the account. You know, if you start trading with, let's say, $10,000 and your account right now is at $2, you're actually dead. It's like going for war. And it's not like every time when you go for war that you die when you lose. There's sometimes that you can no longer fight, you give up. So that means you're practically dead. So basically when you trade also, you have a certain capital, and at the current time you start with 10,000, you're now at $2 or $3, and then you actually lost. Then you're practically dead. So we're looking at what is actually the major reasons why a lot of traders lose their account, lose their total capital in the currencies market.
So, sorry to butt in here. When you say that the trader loses this or this amount, and then does that mean that his account will be wiped out? Does that mean he can't recover or stage a comeback or something?
Well, if he wants to stage a comeback,
coup losses.
If he has to stage a comeback, then he needs to get more funds to the account. It's like the bailout thing for the banks that is causing problem worldwide.
Now, I would imagine that, especially for a trader who is just starting out, an amateur trader, let me put it that way, even though he has gotten maybe basic or advanced training, definitely he's still more at risk of failing, if I can use that word, than at succeeding. So, of course, he would need to fall a couple of times, get himself back up.
Sure. So many times when we talk of traders dying, we're not talking of traders with $200 in their account or $10 or $50. We're looking at people who've actually committed a lot of money to trading and then losing their account.
Over time or maybe in
sometimes it's not over time. You could actually lose your account in a day or two, depending on what you're doing. So
if I've made profits over, let's say, in the last 6 months, I've been successful, and then all of a sudden I take a wrong move on one particular day, and then it's all gone. It's
possible, because that happened for instance, let me take it back to what happened in Nigerian stocks. There are people who have been making money from stock for 2 years, and in less than a week, when we had a crash in the market, they lost everything. So basically, it can happen. It's not about how long you've been making money. It's about not protecting yourself effectively enough as a trader, for you to lose all your account.
Okay, so what could bring about, what are those instances where that a trader would encounter that will make him lose that much?
No. It's not even losing that much. It's losing everything. This is the way it works. The major concept is called margin. You have what we call it in trading margin call. You get that call when your broker closes all your open trades and puts your account in whatever is left, maybe $1 or $2. And what basically telling you is that you no longer have enough capital to sustain your open trade positions. So you have to close them, because basically you're trading because you have the capital to sustain the trades. If you no longer have the capital to sustain the trades, then you have to close your positions.
And speaking of capital, would it be capital from gains made previously? Or does the trader at some point, even with what he has made
your
in
capital
terms of profit,
does
he still add more to the profit in the
possible.
account?
It's possible it's just your capital, or it's possible that it's capital plus profit you've made. Because immediately you make some money, it adds to your capital, and so it keeps growing. But at a point, if you no longer have enough capital to sustain your open positions, then you get what we call a margin call, where your trader, your broker closes all your trades, and all of this is automated. It's being pre-calculated by a software system that calculates how much you have in your account, how much open positions you have, and how much you need to sustain those open positions. So anytime you fall below that requirement, they close the trades, and then we call it you're dead practically, or you have a margin call.
Okay, so I think at this point, let's talk about the do's and don'ts, of preventing a trader from falling into this kind of, because I see it's a trap. I think so.
Well, it's like a semi-trap, because
that's always there at the market.
This is how it works. The currencies market, and like most sophisticated markets in the world, are leveraged. You know what a leverage is? Leverage is just having the capacity to do more with little, and we all like leverage. I think I was taking a class last week, and I was giving them a typical example, because there's no class we do in our training, whether it's an investment training or general foreign exchange trading courses, where we don't talk about money management and leverage. And I was giving a case scenario. If we're going from here to Ibadan, you are trekking, and another person is going in a car, and someone else is flying. If we have any disaster, who's going to be the most hit?
The person in the air, I suppose.
The person flying. Why? Because he's the most leveraged. If you're trekking, worst case, maybe you hit your leg on a stone or you fell down. If you're in a car, you could get something very bad, but it's not worse than someone who's flying. Why? Because he's the most leveraged. In the same way, when you're trading,
the most leveraged, the one who's most at risk.
At most risk. So when you're trading, and it's like you're borrowing more money to do more, basically helping you to make more money faster. which is good. But at the same time, when anything goes wrong, when you over-leveraged, you lose everything. Basically, professional traders, for instance, don't go for more than leverage of 1:2. Basically, that means if I have a naira, I want to buy 2 naira. That's leverage 1:2. So if you have $50,000 in your account, we don't recommend that you open a position that's more than $1,000, which is $100,000 lot size. But you see traders who have just 1,000. We even see traders who have just $250 in their account, who are trading $10,000, $100,000 lot size, which is like extreme leverage. So when anything goes wrong, the account actually goes to zero. Remember that when you open that position, you don't have the money to actually open it. You're borrowing the money to do it. But every loss is taken from your capital. So immediately the fund in your account goes below what is required to sustain that trade. They close everything.
No, so because before now we've been talking about tools, market focused tools, tools that can actually help a trader hedge against risks and losses and all of that. So what if a trader, let's say the person who's flying in the air, now, the one who's most at risk, has armed himself with all of these tools, the moving average, the candlestick, all that we've been talking about, having all those tools, platforms, and maybe even somebody trading on his behalf, and he feels he's safe at that point, and he's trading cautiously, as it were.
Even while it's very leveraged.
Yes. So you're saying that even in that situation, you can still lose it all.
Whether it's trading, whether it's business, whether it's flying, generally in life, this is the way it works. There are some things you have control over, and there are things you don't have control over. For things you don't have control over, you have to be very careful how you trade on them. Typical example, when you are trading, fine, you've done your analysis, you know where the market wants to go, but the truth of the matter is that you don't have control over the market. You don't. Because the market would decide to do anything. Because typical example, dollar could be strong right now, and you have a negative news, which it's not every news that is predetermined. There's some news that is based on natural disasters. You don't have control over that. That could just happen anytime. So basically, when you are trading, you have things you have control over. You have things you don't have control over. You have control over your lot size, the leverage part, because it's not like the leverage is automatically given to you when you start trading. You determine what leverage you want to take. You understand? So you have control over that. So we always recommend that people pay more attention to the areas they have control over. If you can manage the areas you have control over, and even though you're taking charge of the areas you don't have control over also, but you make sure, that you don't take your risk on things you don't have control over, so that you can consistently have the resources to stay in the game and make consistent profit. You understand what I'm saying? So
what scenarios, circumstances, what hypothetically speaking, that the trader can have control over? Can you give instances where, okay, he's trading in a particular part of the market, and then he knows that there's control here, or he can control here, and then another, on the other hand, where he might be swimming out at sea and, without a lifeboat or something?
Now, you see, the way people trade professionally is that, fine, you don't have control over what the market does. Fine, you've done your analysis, Euro wants to go there, for instance, from the news that came out over last Friday, everybody knew the Euro was going to gain strength, because from the meeting with Angela and Sarkozy, everybody knew, okay, Euro is going to start getting strength. Now imagine if a trader goes out there and, it goes to take every risk on that particular move, even though it was right. But you also have to take in mind the times you are wrong. Because trading is about being right, but you can't be right all the time. So you're going to be wrong sometimes. So when you're trading and we're talking about risk management comes into play when you look at those times when you're wrong, because you can't be right all the time. So those times you are wrong, you cannot afford to have your account, depreciated or lost, because immediately that happens, you are totally out of the game, and then you get discouraged and you'll be like, the currencies market is negative. So those are the times you are planning for. You are planning for those times in which the market might not go in your favor. Those are the times you're trying to manage your risk with, So fine, you could be right 80% of the time, but those 2% of the time, 20% of the time when you are wrong, what do you want to do? You don't want to lose your account in those times. That's why you have to, with that mindset, make sure even though when you are right, you're still managing your risk as effectively as possible.
Okay, now how often do you have this occurrence? You have clients or students who have come for either the basic or the calling up Alpari and saying, Alpari, I have lost this or I've lost that. What should I do? What can I do? How often do you have this occurrence?
Well, for practically everybody who's gone for an FX course, FX training, would have had an idea what money management is about and all that. But the problem is that, like we did in the last episode, we're looking at having a trading plan and also trading your plan. There were two sides to it. You have to have a plan, then also trading the plan. The problem with most traders is that, fine, they have a plan, but the issue is that they don't follow their plan. They don't trade their plan. So typically, you can't erase it from trading. You have traders who lose their account. And what we're trying to say is that the problem is not the FX market, because that could happen to you in any market. The major problem is that you are not managing your funds effectively. Your money management skill is not in place, and so that's the reason why you're losing. So we get that, sometimes we have people who lose their account.